Welcome back, you legends. I'm Dr. Khan. Let's get right into this video and look at the contrast between today and yesterday. Just look at this sea of red. We went from a sea of green to a sea of red in a single day. And what do you know? This is what bear markets do. The S&P 500 today is down 2.1%. The NASDAQ is down 2.8%. The Dow is down 1.5%, slightly lifted by the strength in energy due to the decline in the dollar today. We had some selling in the dollar. Now, do you remember, guys, yesterday I said to wait for the dollar to retrace back at least to the 9-day EMA. That's what it has been doing on its way up. It tends to rally, retrace to the 9 EMA, and then continue to rally, right? And today was a very peculiar day, right? Because yesterday we had the stock market, the S&P 500, rally on the weakness of the dollar, on the weakness of the yields. And today we actually had the stock market sell off significantly while the dollar is declining and why yields are cooling down, and we're seeing buying in long-term treasuries as well as gold. We'll get to all of that in just a second. Let's take a look at the sectors for the day. Leading is energy, still in the red, but again lifted by that weakness in the dollar. When the dollar weakens, everybody, we see commodity prices move up. That includes oil, and it allows energy stocks and basic material stocks to breathe a sigh of relief for at least just a little bit. Now, lagging were consumer cyclicals and, very surprisingly, utilities and real estate. Usually on a red day like this, we see utilities, defensives, and healthcare leading as the most defensive sectors in the stock market. So what is exactly going on? Why is a defensive sector like utilities, a defensive sector like real estate, underperforming the S&P 500 today? Well, unfortunately, guys, it's because of this. Look at the destruction of Hurricane Ian. I don't even know what to say. It's just absolute carnage, and I really hope the folks out there in Florida get the help that they need, because this is just so sad looking at these images. This was one really, really bad storm. Look at it, just absolutely devastating. Let's try to make a difference here, everybody. If you can spare a few dollars, please go and donate to the Red Cross to help the folks out there in Florida, because this is one bad storm. I'll leave out a link in the description box below the video, guys, for anybody who wants to donate to the relief efforts by the Red Cross. So this is why utilities and real estate really took a hit today. It's because of this. Ian leaves Florida's grid in tatters despite billions spent. This is a really bad figure, guys. 2.6 million homes and businesses without power. That's 2.6 million homes and businesses. Not individuals, it's homes, it's families, it's businesses. And I really, really hope the administration steps up and provides the necessary help and support. And if they don't, if they fail us again, we need to step up and help each other out. So that's why, guys, utilities and real estate are underperforming the S&P 500 despite both being defensive sectors. A very similar thing happened with consumer defensives back in March when the stock market took a hit after the invasion of Ukraine by Russia. And we saw big companies like Pepsi, like Coca-Cola, like McDonald's abandoning their businesses in Russia. We saw consumer defensives underperforming the S&P 500 for a few days. Now let's go back quickly to the S&P 500 stock market map. Do you guys remember my post yesterday where I said that it was very peculiar to see Apple in the red and everything in the green, and that the market is ignoring this at its peril? They are all wrong. Apple is right. Well, as it turns out, guys, Apple was right. The rest of the market did follow, and this is what tends to happen in bear market rallies. We see a lot of these shenanigans where the S&P 500 rallies in a bear market sell-off, closes near the highs. Again, this happened 7 times back here where we closed near the highs, right? And then completely reversed to the downside the next day. And we can add to yesterday to that list. Look at this, guys. We rallied to the upside and we closed at very suspicious levels. We closed exactly at the gap fill level, and on the 1 hour chart we closed exactly at the same level where the bear market rally, the last bear market rally, failed. And as I said, in the last video, I don't believe in coincidences. This was not a coincidence. Mr. Market knew exactly what he was doing, or Mrs. Market, I don't care. The market knew exactly what it wanted to do, and it wanted to trap bulls here so it can flush down, aggressively sell off. And I suspect, guys, that we will see continued selling really towards the lower edge of the weekly expected move at $356. And now I'm anticipating something that looks like this tomorrow, where we gap down, sell off, take out the weekly expected move, and then reverse back by the end of the day, by the middle of the day, whatever, and close near the weekly expected move, forming a nice hammer candle. Now that's what I'm hoping for. That's my ideal scenario to turn from being bearish to being bullish, to take advantage of that first half of October relief rally that we tend to get in midterm years. And let's bust out our trusty seasonality chart. Look at this, guys. We tend to see this weakness towards the end of September. And then in the beginning of October, towards the middle of October, we tend to see these small relief rallies. They could be small, they could be medium rallies, they could be face-ripping rallies. We don't know yet, but we know that we could get a nice rally towards the middle of October. And we're now getting some really nice divergence signals. Some really nice divergence signals are beginning to form. Let's start out with the HYG, the high yield bonds. This is one of my favorite signals, guys. And it's when the smart money, the bond market, makes a higher low while the S&P 500 makes a lower low. This is a nice bullish divergence beginning to form today. And I'm anticipating that tomorrow we'll get another dump in both the high yield bonds and the S&P 500, with the S&P 500 making a new low and the high yield bonds making, again, a higher low, continuing to build out this divergence. Now let's take a look at the VIX, guys. And again, the VIX is forming another divergence signal, exactly the kind of bullish divergence signal that I was talking about yesterday. Remember, guys, in yesterday's video, I did point out that when the VIX makes a top, we tend to see the bottom in the stock market several days later, not on the top, but several days later. Here's an example. The VIX put in a top, we made a lower high several days later, and then the bottom came. This is another example right here, guys. We had this blow off top in the VIX. We had another lower high in the VIX. We had one tradable bottom. We rallied. We had another lower high in the VIX, right? And then we had one more low, and we built out this nice divergence. And we had several other divergences here, including the HYG, including the PPO on the S&P 500, creating a bullish divergence. So we had several bullish divergence signals building here, and that's what prompted us to go long back here in late May. The same thing happened here in the June low, and the same thing is happening again here as the S&P 500 begins its bottoming process. I don't believe that this is the bottom, but a bottom, a tradable bottom, where we can get a nice relief rally. Now, guys, I did talk about this divergence in the VIX and the HYG as soon as I saw it in the trading community. I commented about it about an hour and a half before the market closed. My time, everybody, is UTC +3, so 11 p.m. is when the stock market closes for me. This is exactly what I was talking about in yesterday's video. The orange line is the S&P 500, this orange line. The VIX is now making lower highs as the SPY is making new lows. A bullish divergence is now building. This is what I want to see. I'm now done shorting and pivoting to bottom hunting over the next few days. We have more work to do. This is not the bottom quite yet, but we're getting closer. I also pointed out the HYG divergence. And if you guys like this sort of live stock market analysis, you can check out the link in the description to join the trading community. It's $20 a month, and it's the best way to support me if you want to do that. And you get access to all of my trading activity, all of my entries and exits in real time, and my technical analysis in real time, and a lot more other cool stuff. So if you like the channel, if you like my work, and you want to support me, this is the best way you can do it. Other ways you can support me, guys, is by slapping that like button, commenting, and just enjoying the content. I'm very thankful to everybody. We hit 5,000 subscribers today. So thank you, everybody. Thank you to all the legends in the trading community and all the legends watching the videos. Thank you so much, everybody. You're making this dream come true. Now, I've never done this, guys, but I do want to share a few really quick, nice comments that I got from the trading community members and the sort of things that makes you warm and fuzzy inside. I'm not going to read any of them really. If you want, just pause the video and read them. And I just wanted to point out that one of the trading community members made over 100% today. It was all him. Kudos to you. You know who you are. You are a legend. This was an amazing trade. Another member made 66% on one of our trades. Again, it was all him. He entered, he exited, he knew what he was doing. You know who you are, an absolute legend. Again, I'm not going to read these guys. If you want to read them, just pause the video. This is another comment that I wanted to share really. I just wanted to share this. This community is epic. Yes, it is. You guys are epic. This community is absolutely legendary. Thank you, everybody. You are amazing. Now, let's go back to the charts, everybody. This is the DXY, the dollar index. It's selling off, right? Again, off that news from the Bank of England, but this will only be temporary. The Bank of England is printing more British pounds, and that will only lead to more weakness in the British pound against the dollar index, and this will lead to even more strength into the dollar. So be very careful. I would not short the dollar here at all. And if you notice, guys, look at this resistance line. This is a beautiful resistance line, guys, that marks this beautiful ascending wedge. Usually, guys, an ascending wedge pattern breaks to the downside. When you see a break to the upside, you have to be careful here. But if we take out this support line, prior resistance line, or a support line, if we take it out, this will likely be a false break top, a temporary top. I don't think that this is the top, but this could be a top. If we continue to sell off in the dollar, again, a false break top could allow the stock market to see some buying. And again, guys, I am now pivoting away from shorting, away from being bearish, to now hunting for that bottom. And of course, everybody, I will share with you all when I think the bottom is in. And most importantly, I will share with the trading community when I will be entering my next trade. If you're in the community, you already know what my next trade is and my target and what company. You all know, and we're getting very close. Now on the S&P 500, everybody, I'm waiting for something that looks like this again, a nice flush down, another low, a significantly lower low, with the PPO making a higher low. That will create a nice divergence on the momentum. In addition to that nice divergence on the smart money and on the VIX. So we get a lot of divergences here, and we get a nice entry signal if this happens. And I do suspect that this will probably happen over the next couple of trading sessions. Hopefully by tomorrow, we'll have that nice bullish hammer candle by the end of the day, where the market gaps down, flushes down, and then the weekly expected move acts as a magnet, and we get a relief rally towards the end of the day, perhaps the middle of the day, and again close with a nice hammer candle. Now let's take a look at the triple Qs, and again, guys, look at the triple Qs underperforming the S&P 500 and getting very close to taking out the June low. I do suspect that the triple Qs will take out the June low. We did take out the June low in the intraday trading, and I suspect that will happen again over the next couple of trading sessions, more likely tomorrow, because we have a lot of economic data dropping tomorrow, so expect a lot of volatility, and with volatility comes a lot of selling and choppiness. Now, again, something I talked about yesterday that alerted me that this is a very bearish structure, pretty much the same thing on the S&P 500, and it has to do with this, everybody. Look at this. This is a descending wedge pattern. This is a bullish pattern. And as soon as we break above this resistance line, we tend to have a nice relief rally. And yesterday, I warned that this looks very weak, very anemic to me. In fact, it does not look like a bear market rally, more so a bear flag. The exact same thing happened on the triple Qs. We had this nice, beautiful, beautiful descending wedge. We had this really powerful breakout in mid-September, and this breakout was so much weaker, and it looked like a bear flag, and is now breaking down exactly as you would expect a bear flag would. Now let's take a look at the 10-year yield. Again, the 10-year yield is calming down, but we're only retracing back to the 9-day EMA. Now, if we see a breakdown and a close below the 9-day EMA, again, that would be another nice bullish indicator that we could see a temporary bottom in the 10-year yield, allowing for that first half of October rally that I was talking about. Again, looking at the TLT, we're still seeing strength in the TLT, right? It's only down half a percentage point versus the stock market, the S&P being down 2%. So we're seeing buying in the long-term treasuries. We're seeing strength in the high-yield bonds. We're seeing the 10-year yield calming down, and we're seeing the dollar calming down. All of these signs, as well as the bullish divergences that are building out, indicate that we could see a nice tradable bottom coming in really soon. Now let's take a look at Apple. This is Apple. And remember, guys, yesterday I said that we need a very bullish, strong green candle to confirm a morning star pattern. We had the opposite today, as I suspected. This was very suspicious to me because, again, we were not able to retake the prior low of 150. This was the prior low on a closing basis from the top in mid-August. We failed to take it. We rallied to it. We reversed back. And we failed to take it, and that was a hint that this again was a fake bear market rally, a fake out, and we had the confirmation today with this massive dump. I suspect the selling will continue tomorrow on that volatility from the from all of the economic data releases. Let's take a look at Tesla. Again, Tesla is showing signs of breaking down exactly like Apple. We failed right at the top of this demand zone that I drew out. And yesterday, again, guys, I said that this close exactly at the top of the demand zone is not a coincidence. The market knows exactly what it's doing. And this close was a bearish indicator. They closed it exactly where you would expect for the bears to do. And we had this massive, massive, massive reversal today with Tesla underperforming the S&P 500. Nearly 3 to 1, even more than that, more than 3 to 1, right? The S&P is down 2%, Tesla is down 6.8%. We took out all of these lows. We are now destined, everybody, to go back to my level of 250 that I talked about in the trading community, and all the way down to that full measured move, right? From the bottom to the top, a full measured move would take us down, boom, to $225 to revisit this low. Now, guys, even if we get a nice relief rally in the first half of October, my suspicion is that Apple and Tesla will continue to underperform, not necessarily sell off and go all the way down to my target by mid-October. Likely will hit these targets by the end of October, but from now to the middle of October, I suspect that Tesla and Apple will underperform the market. The market might see some nice rallies. Tesla and Apple will likely show weaker upside momentum. Now let's jump into the fear and greed, everybody. We're now at 15, and I suspect again that we will see 0 by the end of October. Market momentum is weakening. Look at this, guys. This was a nasty, nasty bear market rally. A fake out bull trap, as we suspected. I did say that I do not trust these bear market rallies, especially when I'm not seeing bullish divergences, when I'm not seeing bullish structure and technicals pointing towards a nice rally. We're now starting to see that. We did not have that yesterday. That rally off the Bank of England news was totally bogus. And we had a lot of hints that I talked about indicating that it was a fake out. Stock price strength continues to weaken. Stock price breadth is really nearing a new low here. And this is the McClellan Volume Summation Index. So it's a little bit lagging. So we could see it take out this prior low. In fact, it will take out the prior low. And that's totally fine. We could see it take out the prior low, making a new low, while the PPO, the momentum, makes a higher low. And again, that creates a nice bullish divergence. The put to call ratio made a new high yesterday. We had a little bit of a dip today, which indicates some buying of calls. And I did notice this ascending wedge looking pattern. This is a bearish pattern that tends to break to the downside. And the put to call ratio is a contrarian indicator. So a bearish development in the put to call ratio, where it starts to build out this bearish descending wedge, indicates that perhaps a bottom is coming and the put to call ratio will break down. Market volatility, everybody, made a lower high today despite making a new low on the S&P. Again, a nice bullish divergence signal. Safe haven demand, again, making a higher low today. Bonds versus stocks making a higher low today. The yield spread of junk bonds versus investment grade is making a lower high. Again, another nice bullish divergence signal. Now guys, I'm adding a new buy and sell signal that I've been refining and working on over the past several weeks, and I just wanted to share it with you today. This is the CPC, the put to call ratio, and I looked at all the times where we had a bullish crossover on the PPO, right? All the times where we had a bullish crossover and all the times where we had a bearish crossover. And what I found, everybody, is that when we get a bullish crossover in the put to call ratio, i.e. people are buying more puts, less calls, they're getting more bearish, we tend to see nice sell-offs, right? Systematically. Sometimes it tends to lag just a little bit by a day or so, but the signal, guys, has been very accurate year to date. And the inverse is true when we see the put to call ratio making a bearish crossover. We tend to see a nice relief rally, a nice bear market rally. Now you'll notice, guys, that there are a bunch of bearish and bullish crossovers that I did not mark with these signal lines, and it has to do with my refinement process. I noticed that if you simply go by the PPO bullish and bearish crossovers, you will get some false signals, and the way to eliminate those false signals is to mark the put to call ratio on the chart with a 0.95 level and a 1.1 level. And the way to read this chart, guys, is this. We need to see a bullish crossover when the put to call ratio is trading below the 95 level to confirm a sell signal. The opposite is true. We need to see the put to call ratio trading above 1.1 before making a bearish crossover to confirm a bullish buy signal. I hope that makes sense, everybody. I'll now start sharing this buy sell signal in my videos, and of course in the trading community live. As soon as I see the signal trigger, I'll share it with everybody. And now, guys, I'm watching this bearish structure, right? This ascending wedge bearish structure. As soon as we cross below 1.1 and we see a bearish crossover on the PPO, that would confirm a buy signal. Now, guys, I'll probably be front running this signal using the HYG divergences, the VIX divergences, and the double bottom bullish divergence on the 2-hour chart as soon as that builds out. This divergence, everybody, where we make a higher low on the PPO and a lower low on the S&P 500 chart. These signals, guys, will probably trigger just a day or so before the CPC buy signal is triggered. And so when we get that buy signal, it will only confirm that, yes, we got the entry right. If you want to be more conservative and wait for the signal, that's also totally fine. You will not miss out on a lot of upside, right? Because here it only flashed just 2 days after the bottom. And here it flashed just 1 day after the bottom. So it is a reliable signal. It's only late by like a day or so. So it is still an amazing entry and exit signal. Now let's jump into the economic calendar. What we have coming up tomorrow is a lot of data, guys. We have the personal spending and personal income coming out tomorrow. The dreaded PCE price index, the preferred inflation measure by the Fed. We also have a lot of Fed speakers coming out, and we have the Michigan Consumer Sentiment Index and the 5-year inflation expectations. So to wrap this video up nicely, everybody, what I'm waiting for, what I'm hoping for tomorrow is something that looks like this. We gap down, we open down, we continue to sell off, we have a very aggressive sell-off, and then we reverse back and retrace back to the weekly expected move. That's what I'm hoping for. That would be my ideal entry. I don't want to see us rallying right off the top tomorrow. I want to see one more low, and I want to see the HYG selling off again, but making a higher low as compared to the September 27th low, where we continue to build out this beautiful bullish divergence. I hope you found this helpful. That's all I have for you today, guys. Thank you so much, and I'll catch you in the next one. Bye-bye. Oh, wow.